I'm confused. That's what I like to say.
Confused about CPI, rates, the economy,
gosh.
prices, the opportunity, what we should be doing, where we should be having fun. Is there a war? What's really the news?
Not
What's
laughing
happening
at the
with
war,
the stock
but yeah,
market?
just all of it. But to isolate it to real estate, we talk about the Federal Reserve. We talk about inflation. We talk about mortgage rates. We talk about supply and demand, inventory. Should you be buying? Should you be selling? Should you wait? Should you start doing it today? I guess what's confusing is data came out yesterday saying that, it's actually better than we thought, but does that mean that's worse, right? Is the Fed going to raise now, or are they less likely to raise?
Yeah.
But then you have other people saying, no, this is signs that actually things are way better than they were reported on.
Yeah.
So it's so confusing watching different YouTube videos, reading different articles, and trying to read the news. And I guess my question for you is, can you kind of sum it all up about what is going on? And again, like we always try to do, what's the rest of 2023 look like?
Yeah. So CPI came in, and CPI basically came in lower than expected. The core part came in lower than expected. Then we had PPI. PPI is the producer price index. And that one came in much lower. Producer price index is what people pay for. At the end of the day, CPI is a headline type like item, but it's not the Fed's general measurement. The Fed is going to use PCE like we've spoken about before. However, the next part of this is, what does it mean for rates? No one knows. We're all going to make some type of an educated guess here, but you're making an educated guess based on the data. So later this month, and I believe it's July 26th, the Fed is going to come out and they're either going to raise, pause, or lower the Fed funds rate. So let's break it down for a second about where we're at. So they've raised 500 basis points.
So basically,
From zero. 500 basis points is 5%. Right now, with our current monetary policy, we are in what's called a restrictive stance. So there is about 200 basis points, or 2%, is restrictive against the economy. So that's a headwind. You're on a boat and you're trying to go through Lake Chelan, and the wind's blowing at you, the waves are coming at you. That's the restrictiveness that we're specifically talking about. Some people believe because we're already restrictive, why make it more restrictive? When you go to the Fed's own watch tool, they believe there is a 92% chance, this is what the market is betting, is that in 2 weeks, the Fed's going to raise 25 basis points. I'm going to just stick with my original call and say the Fed's not going to raise. But at this point, I don't know that it matters. We're getting data and indication that inflation is coming down. It's slowing down. And rates are high, but they came down a little bit based on this positive economic news. And it's going to be higher for longer, even though we don't want it to be. So rates are going to be a little bit higher. And the Fed has two more, in their book to raise in July, and then maybe again in August. Now, whether they do or they don't, though, they're already sufficiently restrictive, so they just may become more restrictive. So you can kind of play this out. Once again, I'm betting they're not going to, so I'm in the minority. I'm like 8%. The other 92% believe that the Fed's going to raise. If the Fed does raise, there is a higher likelihood that they're going to have to lower rates quicker because it's going to become even more restrictive. So go back to the boat analogy. So the boat's going across Lake Chelan. And of course, I'm thinking about Lake Chelan because I was just hanging out with all the homies. Is that, instead of a 5 mile an hour wind against you, now there's like a 10 mile an hour wind. So it just slows it down that much more. If they do raise it, I believe that we will get a reduction in rates faster. So once again, this is just simple educated guess. Expect higher rates through the rest of the year, and then probably second quarter next year, expect them to start to calm down. Now, calm down, people immediately start to think, whoa, it's going to go back to the threes. I think next year we might be in the low sixes to upper fives. That's going to be the cooling down. It's going to take until probably 2025 or 2026 for us to get into that 4 to 5% range. Morningstar Financial, they released something last week and they made a bold call. It was kind of cool. They said rates will average 4% in 2025. Well, that means if they're averaging 4%, that means some of it had to have been 3 and some of it might have been 5 to get the average of 4 in the middle. Bold prediction. I don't believe that we're going to get there, but there's some people now calling for even lower rates. Regardless, what does this mean for us today, and what does this mean for home prices? Traditionally speaking, when we look throughout the Seattle metro, home prices, and matter of fact, this happens for the whole United States. The market appreciates basically through the spring market. So understand that by June, the market generally speaking stops appreciating and sometimes has a slight depreciation towards the end of the year. So let's think about this. Let's put on our buyer hat. Let's put on our investor hat and be like, okay, where's the opportunity? Are rates going to be higher this fall and winter?
Yes.
Are we going to have some possible negative economic news and political news?
Potentially, yes.
So we're going into what could potentially be a slightly colder winter. Now, when I say colder, I'm not talking temperature. I'm talking the real estate market. So I want you to put on your opportunity hat. If you're that buyer who's been making offers and losing out, this next 6 months is going to be that opportunity. If you're that investor who is looking to go in, short term or even long term, now is the time to start hunting and getting ready to make offers. So I was hanging out with a few of my friends, Ronnie Wilson, Jeff Latham, Jason Gosser, phenomenal people in our industry. And we're hanging out on a boat floating around the Columbia River. You know what we're talking about? We're talking about opportunity. We're talking about what's coming later this year and how we want to make, to use Patrick Bet-David, maybe some slightly disrespectful offers on things. And I forget who said it, was one of them, like, yeah, if you don't feel comfortable sending the offer over, that's the one you should make. You should make your stomach turn a little bit and you should be maybe embarrassed about it. I'm not saying you're going to get it. And most good offers come from follow-up over a long period of time, not initially the first one. But if I was to say, where's the window of opportunity it's coming right then, because we just have market uncertainty. We know the rates are going to be higher, whether they move up or stay flat. We know they're higher, and market uncertainty, and then you're going into an election year. That's a recipe for deals. Okay, magic recipe for deals. So be looking, get my credit ready, get my cash ready, get my lending ready, and start hunting today, because it may take you 90 days to find that deal. Now, of course, I also think this is going to extend into first quarter and probably second quarter. But I believe by second quarter of 24, the Fed is going to start to scoot rates down, because what they are showing is inflation is coming down. It's just not coming down as fast as everyone wants to. So we're starting to beat it, but don't get euphoric over these inflation headlines that, oh my goodness, we're hitting CPI in the 3%. The Fed has made it very clear that their long-term target is 2%. And the Fed has said, we don't believe we'll get there until 2025. They're telling you where they're going. Now, it doesn't mean that rates will be extremely restrictive during that whole timeline. So when I say prices may drop, once again, I think our mindset and our emotion goes to the Great Recession. And we think 10%, 20%. I'm saying 2, 1. And most of the United States, and definitely the Seattle Metro, is going to end up just, if anything happens, just slightly less than where they were a couple weeks ago in June. Don't expect it to all go away. Now, like we talked about before, if interest rates go to 8, 8.5, these bets are off. That will cause price compression.
Opportunity, though.
Massive opportunity. So it's really weird. As an investor or just a regular home buyer, you get so emotionally wrapped up in this. If rates were 10, would it create good deals? Absolutely. So ignore that and just focus on your buy box and say, does this match my criteria, my goals, and can we afford to do it, and do we have prudent reserves? And if the answer is yes, go make it happen. Because the other thing I talked about with that same amazing crew of guys was, as rates come down, what's going to happen to prices?
Go up again? As rates come down.
As rates come down,
there'll be more people in the market, more demand, and if inventory is low, naturally prices will get competitive and go up.
So right now in the Seattle metro, prices are rising. If rates come down, what's going to happen is that allows more buyers to qualify, more investors to qualify, and of course, corporate America can go borrow more debt. That creates more demand, but we're in a low supply situation. So that's going to cause appreciation.
When it happens.
Which
might highly likely be next year, even maybe 25?
Yes, exactly. Start in 24, probably more likely 25. But start making moves today, because a question I got asked on Instagram was, hey, should I wait? You can't outsave the current rate of appreciation in most major metros. So if you're going to buy a $600,000 house and the market appreciates at 5%, that's $30K that just went onto the price. So if that home was $623 in 24, it's going to be $630,000. Well, if you could only save 15 grand or 20 grand, you can't outsave that rate of appreciation. And 5% is low relative to what we are experiencing here locally. If you're experiencing something different, tell us in the comments below. Tell us we're wrong. Explain or show us what you're seeing. We'd like to hear what you're seeing locally, because we really follow Seattle. We look at most of the metros, but there's so many nuances because every market's specific.
It's kind of crazy if you think about what you just said, because as the house prices naturally increase over the decades, right, that 5% is much more significant in the dollars, but the wages and salaries aren't going up. So like you said, right, in 2008, when things were kind of going down, right, not the rock bottom, but going down, how much was that $600,000 house?
Oh, in 2008?
Yeah.
Are we talking like as it's
not
crashing?
Rock bottom, just like kind of where like it was getting low average.
That $600,000 house was probably a $550,000 house in the beginning of 2007. And then by 2008, it had probably already dropped 5 or 6%.
So let's just say like by 2010, when things started going back up, what was the price then?
Well, our market, each market's different.
Yeah, right.
The Seattle Metro bottomed in 2012.
Yeah.
So by 2012, that $600,000 house was like 180 grand.
So let's just take a ballpark 250. 250,000. Not rock bottom, but 250,000.
$250,000.
5% appreciation of 250,000 is what, about $12,500.
Yep.
Okay.
100%.
5% of 600,000 is what?
30 grand.
30 grand.
Yeah.
That's almost triple. Right? Like,
yes.
think about now, obviously the price is triple, but you have to think about this. Did the salaries also go up by triple? So we're just talking about the next couple years. This is where it gets kind of crazy. And so like all that explanation was great, but this is kind of like crystal ball kind of talk. Okay.
Yep.
All that money printing hasn't gone away.
Correct.
And the inflation not only is sticky, but might not reveal itself fully till long term. So like you said, if inventory is low, meaning there's not a lot of houses to buy, and because of the economy or whatever the Fed decision is, they decide to start lowering rates to get the machine up and going, naturally prices go up. And that's what's nuts about it.
Yes.
People are going to start getting FOMO again. They're going to have fear of like, I don't want to miss the boat this time. When I missed it in 2021 at rock bottom, right? Or I missed it way back in 2012. You know what? People are understanding that, man, real estate, buying a house is more critical than ever when the opportunity arises. Probably never see those 2%, 3% mortgages, right? But I mean, as we're coming down from 8, 5 looks really good. So people start jumping in because they're like, I don't want it to go back to 8, or I don't want to get in the market 2 years down the road where that $600,000 house, like you said, at that rate could easily become $700,000 or $800,000.
To boil it down, and let's just attach some real math to this. Somewhere between 2024 to the beginning of 2026. So let's just say 2025, the Fed is going to bring those rates down, and we're going to go into whatever our long-term average is. And let's say it's 4.5 or 5.25. With just the base level of demand we have right now, if rates move from basically 7 to 5.25, you are going to see above average appreciation. And here in the Seattle Metro, you will see double-digit appreciation. So this affordability problem that we have today is going to get even worse, and we're going to price even more people out. And then you're going to turn around and flip it and look at the investor side, and it's going to put upward pressure on rents. So the thing that I want you to do, me, all of our friends, the people who are listening to this right now, is I want you to go buy, because I want you to be able to get on that ride. I want you to be able to experience that wave as it comes up, because it's pretty clear it's going to happen again. So don't miss this boat. Go get on that one and capitalize on this. Wealth is created during major transitions and recessionary times. So whether or not we go into a recession, is this a major transition?
Definitely.
So it's that opportunity that creates it. And you know what? If the market did drop 10%, who cares? Over the long run, okay? Because we owned rentals through the Great Recession, and some of the ones we bought were worth like 50% of what we paid for them. Makes your heart sink. Guess what? They're all worth more today. So, as long as you're not just, going to own the house for a year or two, it doesn't matter. But I don't even think we're going to see a downturn. I think it's just up, 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 because there's nothing fundamentally coming to change the affordability and the supply problem.
Yeah, and pun completely intended. Upside is on both sides, meaning even if there's a price correction, just like in 2008 to 2012, if you're buying on the way down, man, you were just raking in some major appreciation, right?
Yep.
Plus you were getting more units, more doors, more rentals, more potentially, houses just to sell, building that portfolio. If it doesn't correct and it goes up, well, you're buying early.
Exactly.
Compared to later, which is again, and that's why it's interesting this time when things are confusing. I'm going back to this original kind of question about being confused about the signals and everything. I want to summarize everything, and then let's go ahead and wrap it up. So have a lot more clarity. There was data that came out that seemed like inflation and data points that would influence whether or not we're in a good place. That seemed to be okay, right?
No, it was great. That was good news.
So then the Federal Reserve, who controls the interest rates and the monetary system, they determine, hey, maybe we don't have to be as aggressive, but it's highly likely they're going to raise. So the reason that's important is because the Federal Reserve's interest rates will influence inevitably mortgage rates.
Correct.
So what we're seeing is high mortgage rates. We're talking 7% right now.
6.96. I looked before we walked in.
Yeah, but it was 7.22 last week.
Bingo.
Probably going to hold to the end of the year. So guess what? Your mortgage payment is really high because house prices, at least right now, haven't majorly come down at all. In fact, there was some appreciation, right?
Bingo.
And so the rest of 2023, time to be looking, because whether there's a correction or they lower rates sooner than we think, it's going to start going up. Because again, this is the big thing. How many times have I joked to you that everybody's becoming an economist now, right?
Yes.
Caring about the inflation. Before literally 2020, no one really cared about inflation.
Nobody paid attention.
Even the Great Recession. Why do people care about it right now? Because we're seeing it in our grocery bills. We're seeing it in what happened with cars, obviously with homes. And back to my comment about 5% on 600,000 is a huge difference than 5% on the 250,000.
Yes.
And it comes down to literally what's coming in and what's going out. we're not getting paid as a society more, right? And at the same rate of the inflation or the inflated prices of goods like houses, cars, and things. So at one point, that's going to create an issue, right?
It's already creating an issue. And this, we'll go over this in probably our next one, is we need to basically break down the affordability crisis in relation to housing. And, you know, I need to go through and dig through all that data. But what you're seeing is that real estate, how many earths are there? One. How much land is available on that earth? Only a specific finite amount.
Unless you're China, because they make islands.
Yeah. Or over in Dubai, they just, put it into the salt
just
water.
Those two countries.
Yeah. So there's only so much land, and there's becoming more people. And those people are all, they're moving to the jobs, to the good climates, things like that. So what happens is we're getting these metro areas that people want to live there, which forces that price appreciation. So you're going to see the forced price appreciation coming. I'm just telling you, go get on the ride and take it. Yes. And it's okay to step in a little too early. That's fine. Okay? I'd rather have you step in a little too early than go in too late or miss the opportunity. And you can contact us by clicking the link up top or sending us a message or sending us a text. And we're happy to get specific in your situation in relation to your investment goals or what you want to buy in our market. And if you're in a market outside of ours and you need help, contact us anyway, and we'll find someone who can answer your questions like we do. You need the local expert who understands that market because each one is different. And mark my words, as rates come down, the market will appreciate both here in the Seattle Metro and nationally more than you are currently thinking because we have not built enough housing. Fundamentally, we are too far behind on supply.
Wow. I'm not confused anymore. Thank you.